Good morning. You're watching live market outlook for Wednesday, 21st of December 2011. Finally, some positive tones seen in the markets as yesterday's strong data from Germany and the US boosted the single currency British pound as well as commodities. Highlights of today come as follows. The stocks, euro and commodities are higher on the upbeat German and the US data. Also the Spanish auction. Bank of Japan kept the policy steady. However, bleaker view on the economy. Today's ECB offer, first offer for a 3-year tender could ease the credit crunch fears. And Japanese November exports fall as Asian demand weakens due to the current crisis. The Asian stocks and the euro were higher in the Far East session after upbeat US and German data and strong demand for Spanish debt tempered risk aversion, with investors now focusing to European Central Bank tender as a gauge for Eurozone funding strains. The risk-sensitive materials sector was among the best performers in the Far East, rising more than 3%, while MSCI, broadest index of Asia-Pacific shares outside Japan, climbed 2.7% on to hit a one-week high and recoup all its losses from the beginning of the week. Today's offer of the Central Bank of European Central Bank is actually sorry, there is a small technical problem. The European Central Bank's first ever offer of 3-year loans is expected to draw high demand from banks and possibly to ease fears of an impending credit crunch and possibly bolstering bond and money markets. The banks cut their weekly intake of ECB funding yesterday, a hint that they are saving firepower for the 3-year operation, and one of several signs it might be popular. They also took 142 billion euros in new one-day loans on Tuesday, introduced by ECB to bridge the gap with an expiring one-week tender for those preparing to take new ultra-long funds. Some 140 billion euros in 3-month money will also expire on Thursday, when the 3-year funds will be delivered, freeing up additional collateral for banks wanting longer-term funds. The ECB has said the economy could tip into recession if banks do not lend to firms and private consumers, and that it would do everything it can to avoid the credit crunch. So this today's action of ECB seems to be quite a good and supportive step to avoid the further negative impact of the current crisis. Back to the Asian session, the Bank of Japan on its regular meeting kept the monetary settings unchanged, but offered a bleaker view on the economy that last month on mounting evidence of the pain Europe's debt crisis is inflicting on global growth and Japan's recovery prospects. The slowing exports, worsening business sentiments and soft capital spending are challenging the central bank's view that the world's third largest economy will recover early next year. In a sign of growing damage from the global slowdown, Japan's exports fell at their fastest annual pace in 6 months in November, with the shipments to Asia declining on the weak demand for semiconductor chips and digital cameras. The Bank of Japan held off on offering additional monetary stimulus as widely expected, but cut its economic assessment to say that the pickup in economic activity was posing due to the effect of slowing overseas growth and the yen's strength. It also revised down its view on export and output growth to say it's flattening and sounded slightly more gloomy on the outlook, warning that the economy will resume recovery only after a brief period of stagnation. Brief look to today's calendar. As mentioned, the overnight call rate of Bank of Japan remains 0 to 0.10%. Japanese trade balance, trade gap actually widened to 0.54 trillion yen compared to 0.28 trillion yen gap forecasted, and the previous month gap of 0.5 trillion yen. Still to German import prices monthly for December showed decrease by 0.4% compared to 0.6%. Showed increase of 0.4%, less than forecasted 0.6%. However, the previous month negative release at minus 0.3% shows today's positive release. MPC, Bank of England MPC meeting minutes are due at 9:30 GMT, and likely voting as forecasted for today was 009, as the same as previous interest rate decision release. From at the same time, PSNB, public sector net borrowing from UK is expected to show increase to 15.5 billion pounds compared to the previous month of only 3.4 billion pounds. This was all from the Europe. In the morning, in the early hours of US session, the retail sales from Canada due at 13:30. Monthly release is expected to show growth by 0.4%, quite disappointing compared to the previous month at 1%, while core retail sales are expected also to decrease to 0.3% compared to previous month at 0.5%. Eurozone consumer confidence comes at 1500 GMT and is expected to decrease to minus 21 compared to minus 20 release of the previous month. US existing home sales at the same time are expected to show increase in the sales to 5.04 million units compared to 4.97 million previous month release. Another supportive outlook for the data from US. And crude oil, US weekly crude oil inventories are due at 15:30. Draw of 2.8 million barrels is forecasted for today compared to draw of minus 1.9 million barrels seen last week. Now the detailed outlook at the markets and the past 24 hours movements. As we can see, the euro is accelerating gains after yesterday's bounce from 130 support zone, clearing 130.42 and 130.84 initial resistances, and breaking also above 131.00 to find resistance at 131.30, approximately 61.8% of the latest down leg from 132.35 to 129.45. Brief correction and pullback seen late yesterday found a good support at 130.60 zone, just below the previous high, and now fresh strength is underway. Clearance of 131.30. So far seen 131.44 is looking for a test of next significant barrier at 131.60's 12th and 13th December lows, where we might see some stronger barrier at this point. However, break here is required to confirm the bottom at 129.45 and look for a test of the break point at 132.00 and then 132.11 and 132.35, above which is to signal a stronger recovery of the pair. However, on the daily outlook, the situation is still in the negative territory. As we can see, the MACD is still below the control line, and the the signal line, pardon, and the momentum holding well below the midline, as broken trend line, the neckline of the weekly head and shoulders pattern offers next barrier at 132.14, and daily 20 days moving average at 132.55, currently maintaining the downtrend. Basically, from the hourly chart, we need to see the break above 132.35, 132.55 in order to improve the current situation on the daily outlook, while near-term studies are quite positive. But be aware of overbought hourly and coming to the close to the overbought zone 4-hour studies that might signal a brief delay before the bulls reassert. Initial support at 130.60 zone is along with the 20 days moving average on the 4-hour chart are expected to contain potential dips in order to maintain the current positive tone with the 130.00 now the trend line support, bull trend line from 129.45, keeping the bulls alive. Loss of 130 would be bearish again, and likely focus 129.45 low of 14th of December. The British pound dollar is also in a strong uptrend after breaking above the triangle resistance at 155.13, where also was 20 days moving average on 4-hour chart, and accelerating gains through initial barriers at 155.56 and 156.00, initially hitting levels at 157, followed by a mild correction. Fresh rally now is underway, 157.39 seen so far, and looking for full retracement. This was actually required to break above the previous high at 130.57 to reattract key barriers on the short term, 157.68, 157.77 highs of 30th of November and 8th of December. This break here is required to confirm the double bottom pattern lows of 154.22 and 154.07, and resume recovery towards 90 days moving average at 158.17 and 158.30, the main short-term bear trend line drawn of 166.17, medium term, pardon, 66.17 high of 19th of August. That will keep the downside out of reach for now and open way for a stronger recovery. On the downside, immediate support today's higher platform at 156.50, along with the 50% Fibonacci retracement around the 156 zone, which is expected needs to hold the dips in order to keep the current bullish tone. However, the gains now accelerating, and the likely scenario would be test of strong barriers at 157.77 and 157.68. Overextended and overbought 4-hour as well as hourly studies might see some corrective action preceding fresh gains. However, the outlook remains positive and supportive for now, and further extension higher is likely. The weakness of dollar weakened the structure of the dollar yen, as the upside remains firmly capped at 78.15 previous highs and 78.00, with the fresh extension lower. Yesterday's briefly breaking below the main bull trend line drawn, short-term bull trend line drawn from a 77.12 low, as the upside stayed capped just under 78 and limited by 20 days moving average. Fresh weakness is now underway, 77.68 seen so far. Key supports at 77.60 and 77.50 are still intact. However, the negative tone that persists on the near-term charts keeps the downside favored, and possible test of 77.60.50 initial strong supports would be the likely scenario, below which to further extend the losses. It's also 77.50 is the low of 9th of December, also the main bull trend line drawn of 76.56 higher low, below which would likely look for test of 77.12 and 77.00 as a figure support, and this might keep the upside now out of reach, and further puts further pressure on the pair towards the downside. On the upside, only break above 78.15 is to improve the current negative tone, and possibly to open way for retest of 78.27 key short-term barrier. Dollar Swiss also under pressure after a brief 2 days consolidation above 93.50, and the pair accelerated losses through 93 zone, which is psychological support, as well as bull trend line drawn of 90.69 low of 1st of December, accelerating losses to 92.65. This was in late hours of yesterday, with the corrective bounce being limited by broken bull trend line and fresh weakness now underway. 92.61 seen, so the previous low has been already retested, as negative studies on the hourly chart favor the further extension lower, as well as on the 4-hour chart, with the immediate barrier coming at 92.52, 61.8% Fibonacci retracement of 90.69 to 95.45 ascent, with next level significant levels at 92.00 and 91.80, the two spike lows of 9th and 8th of December, below which is loss of loss of 61.8% at 92.50, and the 92 handle would be very bearish, and would signal a temporary top at 95.45 in favor of stronger pullback, while loss of 91.80 would likely in the short term reattract levels at 90.66.69, lows of 30th of November and 1st of December. Commodities are regaining strength after talking about crude oil now. After finding support at 92.70 on 16th of December, with a steady rally from here, breaking through our initial resistances at 95. That was a previous strong support, and also clearing the 200 days moving average at 95.72. En route to $100 per barrel, our initial and strong barrier. Current break above 98, which is also 20 days daily moving average, increases positive structure and focuses $100, above which to open 101.36, where is currently main bull trend line drawn of 114.80 yearly high, and next comes 101.40 and 102.42 ahead of 103.35, the latest bull face high posted on 17th of November. On short-term outlook, initial support is standing now at around 97.40, ahead of 96.20 zone, with 20 days moving average at 95.17 currently underpinning the current advance. I would say only loss of 96 level would be bearish at this point, but we need to see a gain of 100 and 101.40 to confirm the positive structure and open way for higher levels. Otherwise, the risk remains of a lower top and the extension of the broader downtrend from 103.35 high of 17th of November. Gold is in a steady rally for past 1 week after hitting fresh low at 1560, with gains now rallying towards 38.2 Fibonacci retracement of downtrend from 1763 down to 1560, currently standing at the level is at 1637 with the 1631 seen so far. 4-hour studies are MACDs currently just breaking above the midline with strong momentum, seeing scope for a further extension higher. However, overbought conditions might signal some corrective pullbacks before the rally resumes, with the strong support above 1600 expected to contain dips in order to maintain the near-term rally from 1560, with the 20 days moving average at 1602.80 underpinning the advance. On the daily chart, supportive is break above 200 days moving average at 1622. However, regain of 1666 and 1700, as mentioned yesterday in the presentation, is required to signal some stronger recovery, with the break above 1727 main bear trend line to refocus levels at 1763 and 1802, the lower top of 8th of November. Failure to regain 1666 and 1700 would be again risky for a lower top and possible extension lower. However, at this point, near-term studies are still supportive, while dailies are still in the negative field, and some stronger rally and regain of previously mentioned levels is required to confirm recovery.